There's a rule in intelligence work. Most people learn it too late. The loud threats announce themselves. The real danger moves in silence. Financial markets train you to watch explosions. Vertical rallies, violent crashes, panic candles. They scream for attention. But the most important moves, they look boring. Right now, silver isn't screaming. It isn't crashing. It isn't rallying. It's holding. At the same price, hour after hour, day after day. To the untrained eye, this looks like exhaustion. A rally that ran out of fuel. But stop watching price. Start watching behavior. A different picture emerges. Volume is surging. Selling pressure is relentless. And yet, the price refuses to break. That doesn't happen naturally. Something enormous is standing in the way, absorbing every ounce the market throws at it. No emotion, no panic. Just quiet, mechanical accumulation. This isn't speculation, this isn't hype, and it's definitely not retail. You're witnessing the transfer phase. Weak hands exit. Strong hands take control. The future quietly changes ownership. The chart isn't dead. It's being defended. And when you see who's behind it, you'll never look at silver the same way again. Price barely moves. Day after day. No breakout, no collapse, no drama. Most traders lose interest here. Media calls stagnation a failure, a market with nothing left to say. But markets don't work that way. Some of the most aggressive battles in history happen in silence. Price is just the surface. Volume is the footprint. Right now, silver's footprint tells a different story. Price is flat. Trading volume has exploded. Massive blocks are changing hands. Sellers are desperate, convinced the rally is over, and yet the price doesn't fall. This is the first red flag. Heavy selling normally pushes price down. Gravity wins, floors collapse. Not here. Every wave of selling is absorbed, relentlessly, mechanically, without emotion. This is what accumulation really looks like. Not explosive candles, not viral headlines. Quiet defense. Professional buyers don't chase price. They sit at key levels, absorb supply, wait until sellers run out. The crowd misreads this. Retail sees boredom. Algorithms see opportunity. Institutions see transfer. Weak hands leave. Frustration builds. Time drags. Confidence erodes. Every ounce given up, quietly taken. Flat markets feel safe. They're dangerous. Disappointment is a weapon. This pattern appears before major repricing events, not just silver, oil, uranium, copper, currencies, long compression, extreme volume, suppressed price, followed by violent resolution. When sellers are gone, when there's nothing left to absorb, price doesn't rise, it gaps. The illusion of stagnation hides urgency behind boredom. It convinces the world that nothing is happening, when everything is. Silver isn't asleep, it's being loaded. And the longer this illusion lasts, the bigger the explosion. Markets don't stay compressed forever, they explode. And when this one does, most people won't see it coming until the price is already far beyond reach. Most people believe markets move because someone presses a buy button. That belief is comforting. It's also completely wrong. Real institutions don't buy the way retail traders do. They don't rush in. They don't chase green candles. And they certainly don't announce their intentions with explosive price moves. Because the moment price starts moving, cost increases and secrecy is lost. Instead, they use a method that looks invisible, but leaves fingerprints everywhere. It's called controlled absorption. When an institution wants massive exposure, not thousands of ounces, but millions, it cannot buy all at once. Doing so would detonate the price and alert every algorithm, fund, and speculator on Earth. So the strategy is reversed. They let others sell. Every dip is welcomed. Every wave of panic is useful. Every frustrated exit is supply. This is where iceberg orders come in. Orders so large that only a fraction is visible at any time. As soon as one piece fills, another replaces it. To the market, it looks like nothing special. Just resistance, just someone selling. But in reality, the entire sell side is being quietly consumed. The brilliance of this strategy is psychological. Retail traders see a ceiling and assume price can't go higher. Momentum players give up. Media declares the rally overextended. And sellers feel safe unloading, believing demand is weak. But demand isn't weak, it's patient. Institutions don't care if this process takes weeks or months. Time is irrelevant when the objective is ownership, not profit. They aren't trading silver, they're securing it. This is why volume becomes the tell. When price stalls but volume surges, it means a massive force is willing to take the opposite side of every emotional decision the market makes. That force doesn't flinch, it doesn't react, it doesn't chase, it simply waits and absorbs. And here's the key detail most people miss. This behavior doesn't come from hedge funds. Hedge funds need volatility, they need movement, they mark positions to market. They don't sit quietly absorbing supply at a fixed level that's inefficient for performance metrics. This footprint belongs to entities that cannot afford scarcity, entities that care less about price and more about availability. That's when the question shifts from how they're buying to why. Because once this process is complete, the strategy flips, the buy wall disappears, support vanishes, and price is suddenly free to move, not gradually, but violently. At that point, there are no sellers left to absorb. The market discovers all at once that supply is gone. And that's when people realize too late. The most important buying phase already happened, right in front of them, without making a sound. At this stage, most observers reach for the obvious explanation. It must be the banks, probably a hedge fund, maybe a big speculative player positioning early. Those assumptions feel logical, but they collapse under scrutiny, because the behavior we're watching in silver doesn't match how financial institutions actually operate. Banks trade spreads, hedge funds trade volatility, both care deeply about price. What's happening here shows almost no concern for price at all. The buyer absorbing silver at these levels isn't reacting to news. They aren't chasing momentum. They aren't defending profits or hedging exposure. They're executing a single objective with mechanical precision: acquire physical supply without disruption. That immediately rules out most financial players. A hedge fund can't justify sitting on massive positions that don't move for weeks. Their investors demand performance. Their risk models punish stagnation. Flat markets are where hedge funds leave, not where they double down. Banks aren't a match either. Modern bullion banks are intermediaries. They facilitate trades, they lease metal, they manage paper exposure, but they avoid being outright long physical supply unless it's immediately offset. Holding large quantities of real silver ties up capital creates storage risk and invites regulatory scrutiny. That's not accumulation, that's liability. So who buys like this? The footprint points to an entity that views silver not as an asset, but as a resource. Industrial buyers don't care about daily price fluctuations. They care about continuity, about not being shut down, about ensuring that when demand spikes, their supply chain doesn't snap. And right now, silver is no longer just a metal, it's a strategic input. Electronics, energy systems, medical technologies, defense infrastructure. Each of these sectors consumes silver in ways that can't be substituted easily or quickly. When supply tightens, production doesn't slow gracefully, it breaks. That creates a new kind of buyer, not one seeking upside, but one seeking survival. This is why the accumulation is steady, emotionless, and relentless. There's no rush, because the buyer isn't trying to front-run a chart pattern. They're front-running scarcity. They don't announce themselves because they can't afford competition. If others realize supply is being locked up, prices rise, costs increase, access becomes contested, so they stay invisible. The market mistakes silence for absence, but absence would show weakness. What we're seeing is strength under restraint. This also explains why selling pressure hasn't broken price, because every ounce that hits the market is immediately claimed by someone who needs it, not wants it. And once those needs are met, there's no reason to defend the price anymore. That's when the financial players arrive late, chasing momentum, scrambling for exposure, asking questions they should have asked earlier. By then, the buyer is already done. The metal is secured, the supply is locked, and the market finally understands what it missed. Now we reach the hidden force behind the accumulation: artificial intelligence. At first glance, AI seems purely digital: algorithms, servers, neural networks humming silently in data centers. But the reality is far more physical and far more terrifying for the silver market. Every time a ChatGPT query is processed, it consumes roughly 3 to 10 watt-hours of electricity, 10 to 30 times more than a standard Google search. Multiply that by billions of queries, millions of servers, and suddenly the digital economy is a voracious consumer of energy. Dr. Emily Carter, a professor of materials science at Princeton, calculates that high-density AI operations require megawatts of continuous power, far beyond conventional grid capacity. Here's the problem. The US grid, already strained and aging, cannot handle this load. Not consistently, not reliably. Power surges, brownouts, cascading failures. The risk is real. Enter silver, not as money, not as an investment, but as a critical industrial input. High-efficiency solar panels, the backbone of renewable energy solutions, powering these AI data centers, require silver paste in their photovoltaic cells. Without it, the panels are less conductive, less efficient, and ultimately fail to deliver the required megawatts. According to the National Renewable Energy Laboratory, a single gigawatt-scale solar farm can consume upwards of 100 metric tons of silver. That's roughly 3.2 million ounces per project. Suddenly, the accumulation at $63 isn't speculative. It's preemptive. It's strategic insurance. Microsoft, Google, Amazon. These tech giants aren't chasing profit in silver. They're front-running scarcity. They need energy to run AI, and energy requires silver. Miss this step, and AI infrastructure stalls before it even launches. Observe the market. The calm, unshakable accumulation coincides perfectly with the timeline of AI expansion. Algorithms quietly absorb billions of dollars worth of silver. Each iceberg order acts like a dam, holding back the flood of sellers. Flat prices with extreme volume. This isn't stagnation. It's the market bracing for the invisible wall of AI demand. And the scale is staggering. Microsoft alone is deploying billions into solar infrastructure. Just one of its planned solar farms requires more silver than the entire annual production of some mid-tier mines. The AI energy wall is not a theory, it's a looming bottleneck. Once the tech giants secure their supply, the vacuum will trigger the market to reprice silver dramatically, almost overnight. For investors watching a flat chart, it appears tranquil, even boring. But beneath the surface, physics, electricity, and industrial strategy converge. Silver is transforming from a passive asset to a keystone of the AI revolution, an irreplaceable metal that fuels the very brain of tomorrow's economy. And here's the suspenseful truth. Once the tech whale's iceberg orders are filled, the artificial floor disappears. The next spike won't be gradual, it will teleport. Prices jumping dozens of dollars an hour, leaving latecomers behind. The AI energy wall is not just a story of tech demand, it is a ticking industrial time bomb. And the countdown has already begun. The accumulation isn't happening in a vacuum. The tech whale is devouring silver, and the consequences are rippling across the global economy. This is collateral damage on an unprecedented scale. Picture the silver market as a finite aquarium. The water represents supply, the fish represent buyers. When a massive predator enters, the smaller fish get pushed aside. The tech giants, Microsoft, Amazon, Google, are that predator. Their appetite is immense. Their purchases are relentless, and the water is finite. Start with healthcare. Silver isn't just pretty metal, it's the most antimicrobial element on the planet. It's in catheters, burn creams, surgical instruments. Hospitals rely on it. Dr. Laura Chen, a biomedical materials researcher at Johns Hopkins, notes that modern medicine is deeply silver dependent, especially in infection prevention and high-tech medical devices. If supply is redirected to solar panels and AI data centers, hospitals face delays, shortages, and skyrocketing costs. Lives are literally on the line. Then there's defense. Military equipment uses silver for its unmatched conductivity. A Tomahawk missile, a fighter jet cockpit, even advanced batteries and torpedoes rely on this metal. The Pentagon maintains a strategic reserve for national security, but it's not unlimited. If big tech hoards the supply, the military is forced into bidding wars for material that was once reliably available. This isn't hypothetical. It's documented in procurement reports. Once the float shrinks, prices spike, and urgent orders scramble the system. And yet, some sectors simply can't compete. Jewelry, silverware, luxury goods, discretionary markets feel the pinch first. In India alone, cultural silver consumption exceeds 25 million ounces annually. When industrial buyers corner supply, these consumers get crowded out. Households sell heirloom silver. Refiners melt it down, redirecting it to industrial use. What was once decorative becomes strategic. Silver is transforming from adornment to industrial necessity. The psychological effect is just as dramatic. Investors watching price charts see a flat market at $63. They perceive boredom. But high volume tells a different story. It signals a silent battle between sectors, tech, defense, healthcare, with tech currently winning. This is crowding out, a zero-sum game where one giant eats the oxygen, leaving everyone else gasping. And here's the suspense. The longer the tech whale accumulates, the more intense the eventual spike. Once the iceberg order dissolves, prices won't rise incrementally. They'll explode in a vacuum, leaving smaller industries and speculators scrambling for scraps. The scramble itself triggers panic buying, amplifying the spike. This isn't a story about hype or speculative bubbles. It's about strategic allocation, industrial necessity, and physics, the laws of supply and demand acting on an extremely limited metal. The AI energy revolution is reshaping silver's purpose. Once the tech giants are full, the market's next act will redefine access, pricing, and survival for every remaining player. And the ultimate cliffhanger: the accumulation isn't done yet. Who wins the next round? Hospitals? The military? Or the tech whale? The stage is set. The clock is ticking. So far, we've identified the whale. We know it's big tech. Microsoft, Amazon, Google, quietly hoarding silver. We've mapped the collateral damage, hospitals scrambling, militaries bidding, jewelry markets collapsing. But what about you, the small investor watching from the sidelines? Are you helpless? Or is there a strategy to ride the whale's coattails without getting crushed? The answer is drafting. Borrowed from racing, drafting means positioning yourself directly behind a powerful mover. Cyclists ride in the slipstream of the leader, cutting air resistance. Sailors tack behind a faster boat to harness its wake. In the silver market, the whale is the semi-truck. Its iceberg orders at $63 are absorbing selling pressure, defending the floor, and building the foundation for the next surge. Step 1, stay calm. Boredom is the trap. The whale wants you disengaged, checking your chart, thinking nothing is happening. But high volume with a flat price is a sign of accumulation, not weakness. Retail panic is their fuel. Don't give it away. Step 2, buy the base. Every time the price touches the bottom of the consolidation range, you match the whale. Small, calculated purchases aligned with their iceberg levels protect you from sudden volatility. Stop losses go just below their hidden orders. If the whale leaves, you leave. If they stay, you're safe. Think micro-alignment with a $650 million force. Step 3, watch the volume, not the noise. Volume is the heartbeat of accumulation. High volume with flat price, the whale is feeding. Volume drops, the whale is full. That ES, when the markup phase begins, the explosive phase that turns $63 into $70, $80, even higher, you don't need to predict the exact move, you follow the rhythm. Step 4, secure your position physically. Big tech isn't using COMEX or bank vaults, they're using private, non-bank storage. If you hold physical silver, consider the same. The metal you own is real, tangible, strategic. Paper contracts and ETFs are slippery proxies. They 1T shield you if a supply crisis erupts. Step 5, adopt the whale mindset. They aren't trading silver, they are banking in silver, converting cash into strategic industrial energy. Retail investors must shift perspective too. Silver is a fortress, not a fleeting profit. Think long-term. Think survival of capital, not quick flips. The suspense builds, the iceberg won't last forever. Eventually, the whale fills its position. Eventually, the hidden buy wall disappears. The moment it lifts, the vacuum opens. Prices will teleport upward, skipping levels, leaving speculators behind. And if you've drafted correctly, you'll be riding the slipstream, safe and positioned for gains. Final thought, most retail investors sell at the first sign of profit. Not you, not if you draft correctly. You hold, you wait. You watch the physics of supply scarcity and strategic accumulation play out. You are aligned with the most powerful buyer on Earth. The stage is set, the whale is full, the vacuum is forming, the explosion is imminent. Are you ready to ride it? Don't just watch history unfold. Position yourself before the surge hits. Subscribe now and hit the bell to catch part 4, where we reveal the exact breakout targets, warning signs, and the strategy to ride the silver markup without getting caught in the storm. Remember, the whale is full, the floor is set, and the vacuum is about to release. Be ready. Act before the window closes. Subscribe, stay alert, and hold the line. The explosion is coming.